Japan's economic landscape has been marked by significant challenges, resembling the lost decade, with low growth, below target inflation, and rock-bottom interest rates. However, recent developments indicate a shift in this paradigm. On March 19, the Bank of Japan made a pivotal decision to raise interest rates, breaking a trend that had persisted since 2007. This decision, which saw the interest rate target on overnight loans increase from between -0.1% and 0% to between 0 and 0.1%, signals a fundamental change in Japan's monetary policy stance. Before this shift, the Bank of Japan had resorted to unconventional measures to combat deflationary pressures. These measures included yield curve control and negative interest rates, which were implemented to stimulate economic activity and encourage borrowing and spending. The necessity of such policies stemmed from Japan's prolonged period of low inflation. This prolonged low inflation environment had a significant impact on monetary policy and economic expectations, creating a need for bold and unconventional measures. However, recent economic indicators paint a different picture. Japan has witnessed a notable increase in key economic metrics. Rising inflation rates, with inflation above 2% for almost 2 years, indicate a departure from deflationary pressures. Moreover, Japan's biggest firms recently agreed to a substantial 5.3% increase in wages, a level that was previously considered unattainable. These positive developments have also been reflected in the stock market performance, with the Nikkei 225 index recently surpassing its record set in 1989, about 35 years ago. Despite these positive indicators, Japan continues to face significant challenges. One of the most pressing issues is its aging population, with 30% of its citizens aged over 65. This demographic trend poses challenges for economic growth and investment, as a shrinking workforce limits productivity and innovation. Additionally, Japan grapples with stagnant productivity growth and high public debt levels. The debt-to-GDP ratio stands at 255% in gross terms, making it one of the highest in the rich world. These challenges underscore the complexities of Japan's economic landscape and the need for sustainable policy measures. Tracing the Bank of Japan's monetary policy history reveals a dynamic journey from the deflationary challenges of the 1990s to the present economic landscape. The Bank of Japan, BOJ, has employed a range of tools and strategies over the years to combat deflation and stimulate economic growth. These include zero interest rates, quantitative easing, QE, and yield curve control, each implemented with specific rationales and varying degrees of effectiveness. During the 1990s, Japan faced a prolonged period of deflation following the burst of an asset bubble and financial instability. In response, the BOJ began cautiously with measures like zero interest rates, aiming to stimulate borrowing and investment. However, subsequent attempts to raise rates were met with mixed results, highlighting the complexity of managing monetary policy in a deflationary environment. The real shift came with the appointment of Kuroda Haruhiko as the BOJ's governor in 2013. Backed by then Prime Minister Abe Shinzo, Kuroda embarked on an aggressive monetary easing program, including QE and a 2% inflation target. These measures, coupled with forward guidance and yield curve control, marked a departure from traditional monetary policy and a bold attempt to revitalize the economy. Key figures like Kuroda Haruhiko played a crucial role in driving these policies forward. The government's support was also instrumental in implementing aggressive monetary easing measures, signaling a coordinated effort to combat deflation and stimulate growth. However, despite these efforts, inflation consistently fell short of the BOJ's 2% target during Kuroda's term, highlighting the challenges of achieving sustained inflationary pressure. Fast forward to recent times, the BOJ announced significant policy changes, including the decision to raise interest rates for the first time since 2007. This move signifies a shift away from unconventional policies like negative interest rates and yield curve control, reflecting a recalibration of monetary policy in response to changing economic conditions. These policy shifts have implications for Japan's economy, financial markets, and inflation expectations. While raising interest rates may signal confidence in economic recovery, it also poses risks such as dampening borrowing and investment. Moreover, the transition to a new monetary policy framework presents challenges, including managing market expectations and ensuring a smooth adjustment process. Japan's economy faces a multitude of challenges that shape its outlook and trajectory. One of the primary challenges is demographic trends, with an aging population and shrinking workforce. Approximately 30% of Japan's population is aged over 65, leading to structural constraints on growth, reduced consumption patterns, and challenges in sustaining productivity levels. A shrinking workforce limits Japan's capacity for innovation and productivity gains, posing long-term challenges for sustained economic growth. Additionally, Japan grapples with high public debt levels, with a debt-to-GDP ratio of 255% in gross terms, one of the highest in the rich world. With these low interest rates, about 9% of the government budget is paid as debt interest. Rising interest rates and debt servicing costs present potential risks, threatening fiscal sustainability and budgetary constraints. The IMF forecasts 0.5% GDP growth per year for the next 4 years, with 5.6% GDP deficit in 2023. However, there are prospects for Japan's economic recovery and long-term growth potential. Productivity improvements, technological advancements, and structural reforms hold promise for revitalizing Japan's economy. Embracing innovation, investing in research and development, and fostering a business-friendly environment are key strategies to unlock growth opportunities. Despite these internal challenges, Japan is not immune to external risks. Global economic slowdowns, trade tensions, and geopolitical uncertainties pose threats to Japan's export-oriented economy. The interconnectedness of global markets requires Japan to navigate these external challenges with resilience and adaptability. Monetary policy, fiscal policy, and structural reforms play crucial roles in supporting Japan's economic resilience and sustainable growth. Coordinated efforts to address structural constraints, enhance productivity, and promote investment are essential for overcoming challenges and fostering a robust economic outlook. Japan's economic transformation is shaped by a complex interplay of internal and external factors. While challenges like demographic shifts, high public debt, and external risks persist, there are opportunities for growth through innovation, productivity enhancements, and strategic policy interventions. Navigating these challenges successfully requires a holistic approach that addresses structural constraints, fosters resilience, and embraces change for sustainable economic growth.